for joining this revision session. My name is Anne. I'm going to be taking you today through the Personal Tax Finance Act 2024, Tax 6. This is from our Mock 1, and you can follow it through in your first intuition materials if you have them, or otherwise from our revision question pack if you're not an FI student. So what do we know about Task 6? Let's have a look at what sort of thing we are likely to see here. It's a task planning task. It's worth 8 marks, giving you about 12 minutes in the exam to work through this one. And I think one of the value adding services that we can see from tax advisors is looking for legal opportunities for us to minimise the amount of tax that we pay. So if there is a way that legally and ethically we can minimise our tax liability, of course we'd like to take advantage of that. So if, for example, with our employment, if there are some exempt benefits, then let's take advantage of those. Knowing that if we choose a car with high emissions, we'll have a higher benefit in kind. Looking at how much of our fuel we decide to contribute towards, that sort of thing. So there's lots of tax planning opportunities, both within employment and also property income and potentially spousal relationships. So the task briefing here, as always, is incredibly useful, and I definitely suggest that you have a read through this, be it now or perhaps at the end of the task. It's an abbreviated version of our course materials, highlighting some of the key things that will be helpful as we answer this task. So there is the task briefing. So do make your take some time to go through that. There's quite a lot of good stuff in there. In our task here, we have some questions to answer, starting with Reggie. Reggie has total income of £105,000. And the first thing that should perhaps pop into my mind when I see that is, oh goodness, he's going to have a restricted personal allowance because his earnings are above £100,000. They then go on to say, if he pays £5,000 into his personal pension, that will reduce his adjusted net income to £100,000, which will preserve his personal allowance. So let's be a little bit clever with this one, because it is correct in terms of putting money into his pension, £5,000, will preserve his personal allowance, but it won't bring his adjusted net income to £100,000. But it will still preserve his personal allowance. So you have to read the question very carefully, just to be sure that you're understanding all of it. So let's have a think what would happen if he paid £5,000 into his personal pension. Well, remember, if he actually puts £5,000 in, we extend the basic rate band. Which in itself will give Reggie some higher rate tax relief. But the other thing that happens ordinarily is where a taxpayer has income over £100,000, we have to start reducing their personal allowance. But if their income comes down to £100,000, we have no need to do that. But how much would the adjustment be? Well, if he put £5,000 into his personal pension, we would gross that up by multiplying by 100 over 80. So he might put £5,000 in, but because of the tax relief that is received, that would be the equivalent of £6,250 being deducted from his income. So he has an income of £105,000 at the moment. We would deduct £6,250 being the gross pension contribution. So his net income would come in at £98,750. So it's not 100,000, it's less than 100,000. So the answer to that is false. The other perspective on this one is that you could say, if he wants to reduce his income by £5,000, because his total income is 105, and his required income, so he doesn't lose his personal allowance, is 100,000, he needs a reduction of £5,000 in his earnings. how much does he have to put into his pension? And the answer to that is he only has to put in 80% of that figure because the rest is contributed by HMRC. So if he puts £4,000 into his pension, he is still able to reduce his income by the full £5,000. So it doesn't matter which way around you interpret that question, either using the £5,000 given, grossing it up to find out what his income would become, or working out how much he would need to contribute in order to get £5,000 reduced from his income. Either way, the answer is false. Paul is provided with a company car for 24-25 and his employer pays for both his private and business fuel. Paul needs to reimburse his employer for all the fuel provided, as in the private and the business, in order to avoid a taxable benefit on the fuel. That's false. And the reason that one is false is because the rule says he must reimburse all of his private fuel. It would be very unrealistic and unfair to expect him to reimburse the cost of the fuel that is being used in the business. So he does have to reimburse all the private, but he's not expected to reimburse any of the business. So that big far-reaching statement that he needs to reimburse all is false. Then we have an employee who receives 50p per mile, so cash, they get paid 50p for every mile when they use their own car. This payment will be subject to Class 1, primary and secondary national insurance contributions. So, because the employee is receiving cash, albeit for using his car for business purposes, that is actually treated as cash earnings. So that one is true. Now the reference material does tell us a little bit about this. Just find that section here. You can see that there are some approved mileage allowances for employees and residential landlords. So when the employee has details of exactly how many miles they've travelled, they'll be able to claim an expense against their employment income. So we're basically adding on the 50p per mile as an extra salary, if you like, treating it as cash earnings, and then the exact amount travelled at either 45p or a combination of 45 and 25p would then be deducted as an allowable expense. But in the first instance, and in the answer to this question, 50p a mile paid in cash is taxable income and has Class 1 and secondary national insurance contributions payable. Then we have Joe. Joe receives a salary of £75,000, some building society interest of £1,000 and dividends of £1,000. He will have no income tax to pay on the interest or the dividends. Seems a bit odd, doesn't it? Why would he have no tax to pay? Let's have a look. Looking here, Joe is clearly in the higher rate earnings band. With a salary of £75,000, he's clearly in the higher rate. So I just need to check the allowances, because I think this is what this question is getting to. As a higher rate taxpayer, his savings allowance is £500. And his dividend allowance is the same irrespective of whether you're a higher rate, basic rate or additional rate taxpayer, is also 500. So in this scenario, Joe is going to have to pay tax on £500 of that interest because there's a savings exemption for 500 only. So the savings allowance is only 500, leaving 500 still taxable. And the same for the dividend. There's a dividend allowance of 500, leaving the other 500 still taxable. So that statement is false because he will have tax to pay. So I have to say false to the fact he'll have no tax to pay. Excellent. Next part then is part B, where we're going to have a look at a situation involving Archie. So what I've done with Archie, and then in part C, Jack and Jill, is I've just copied and pasted the information into this little section, so we've got some space to actually write out our answer underneath. I'll just see that one's not really, that's better. Okay, not formatted very well. So let's use this one then to talk through Archie. Archie receives a salary of £55,000 and a bonus of 15. So his employer comes along and suggests, rather than taking the full 15,000 as a cash bonus, why don't they give him 10,000 in cash and make an employer's contribution into the pension scheme? Calculate the income tax saving for Archie based on this information if he decides to put 5,000 of the bonus into the pension scheme. His employer would pay this in for him directly. So what I have to spot here is that an employer's contribution into a pension scheme on behalf of an employee is exempt. So that 5,000 that they pay into the pension scheme is not taxable. But what I'd like to do is give you a bit of sort of standard way to appraise these sorts of questions, rather than just answer this one and then leave you with the next one where you think I don't know where to start. Let's rather look at the method. So I would start by assessing where things are now. So let's say this is the current proposal, the current situation, and this is the proposal. So the current situation is that Archie receives a salary of 55,000, and that Archie would then also get a bonus of 15. The proposed situation is that they'll continue to pay him 55,000, but his bonus will be down to 10. Remembering that the extra 5 he will receive, but his pension fund will receive it instead of him receiving it for cash. So when I do that, I can see there's no change with there. The salary is the same in both cases, so I'm not really interested in that. The only relevance of the salary perhaps is just to show me, oh, is a higher rate taxpayer. Because the higher rate tax band is where we have earnings of 37,700 or more. So we're going to be paying higher rate tax on this bonus here. So if higher rate tax is at 40%, under the current scenario, Archie would be paying £6,000 in tax on that bonus. But under the proposed scenario, he would now pay 40% tax on a lower amount and therefore pay less tax. So the tax saving, by going ahead with the employer's plan here, is the difference between the 6,000 current and the 4,000 proposed. So I've got a £2,000 tax saving there. So you may look at those numbers and think, well, why did we have to do all that? Why couldn't we just say he'll get £5,000 less in bonus times by 40%, and there's my answer? And you absolutely can. What I was trying to do here is just to give you a standard format, if you like, that you can use with any tax saving question, where you say, this is where I am now, this is what the proposal would be, let me work out the tax for now, let me work out the tax on the proposal and see how they are different. So you will get the right answer from doing it like this, but you'll also get the right answer from that little shortcut I just suggested, where you recognise that the only difference here is that he's going to receive 5,000 less in cash and therefore save the tax on that. So that was part B. Part C was Jack and Jill, who are married. Jill earns a salary of 190,000 per annum. Let's have Jill here. So this is her current situation. She has a salary of 190, and Jack earns nothing. Okay. Jack has no salary. Jill also has some rental income, 35,000. Jack has nothing, and neither of them have any income apart from this. Although, to be fair, that probably does seem like enough. So this is the situation for Jill now. We're going to have a look at what the proposal is. So they are married. She's earning 190 plus the rental income. So let's see what tax bracket she's going to end up in. She's easily in here, isn't she? She is an additional rate taxpayer. So she's going to be paying 45% on all her income. So she pays 45% on the salary and she pays 45% on the rental income. So Jill is paying £35,000 at 45%. She's paying £15,750 in tax on the rental, because the proposal doesn't suggest that anything different is going to happen with her salary. So it's only the rental bit I'm interested in. So she pays £15,750. The proposal is that we take that rental away from her. So then she'd pay nothing. And what we would do is we would transfer that rental income to Jack. So he would now have rental income of 35,000, from which he would deduct a personal allowance. He has no other income, so he hasn't used any of his personal allowance. So the first thing I would do is deduct the personal allowance, leaving him with taxable income of 22,430. But because he has no other income from anywhere else, he would just be a basic rate taxpayer. So we'd only need to pay 20% tax on that. So we'd pay 4,486. And the proposal for Jill is that she has no rental income at all. So she would go from paying tax of 15,750 to paying tax of nothing. So the overall saving then would be the difference between the 15,750 that Jill would be paying and the 4,486 that Jack would pay if we transferred the rental to him. So that rental income moves over there. Jill has no income. Jill has no tax. So as a couple, they save 15,750 and then they pay out 4,486. So we're looking at 11,264. So a saving of 11,264, and that was worth 2 marks. So I tend not to shortcut my workings on these questions, because I also think at the end of the exam, if I've got time left, I'd like to go back and check my workings. But if I don't really have any workings, then it's a little bit harder to check them. So I like to put something together that I can come back to later and think, oh yes, I understood what I was doing there. Let me see if that's still what I think the answer should be. So there we go, nice little task there on tax planning. Definitely one to practice, because each question can look a little bit different, and often part A of this type question here can catch people out. So do make sure you practice some more of these tasks. I think it's quite an important one to invest a little bit of time in.